Picture this. It's a Tuesday afternoon. You're at work. Your phone buzzes. You glance down and the headline says, RBA raises rates. And something tightens in your chest. Not because you understand what just happened, but because you know, somehow, that it means your mortgage payment is about to go up. You've felt this before, maybe 3 times this year alone. You do the maths in your head. Another 25 basis points. That's what, another $100 a month? On top of the last 2 increases. You're now paying almost $300 more per month than you were a year ago, and you haven't changed anything. Same house, same loan, same job, same you. But someone in a room in Sydney pressed a button, and your bank account got lighter. Here's what nobody explains. It's not random, it's not punishment, and it's not some bureaucrat who doesn't care about your grocery bill. What the Reserve Bank of Australia does when it changes the cash rate is one of the most deliberate, most calculated, most consequential things that happens in this country's economy. And almost no one can explain how it actually works. Not how it sort of works. How it actually connects, step by step, from one room in Martin Place to the number that leaves your account every single fortnight. That's not your fault. Nobody taught you this. Not at school, not at uni, not when you signed your home loan. So let's fix that. Because once you understand the RBA, every rate decision stops feeling like a punch and starts feeling like a weather forecast. Something you can actually read. Here are 2 questions most Australians can't answer. And I don't say that to be dramatic. I say it because I've asked. First, what actually is the cash rate? Not what it does. Not it's the interest rate. What is it? What's actually happening when the RBA sets it? Second, how does one number, decided by 9 people sitting around a table in Sydney, change the amount that comes out of your bank account every fortnight? If you can answer both of those clearly, you understand the single most powerful financial force in Australia. If you can't, that's what the next 18 minutes are for. And I promise you, by the end, both of those questions will feel obvious. Now, before we get into the mechanics, we need to understand why this matters so much right now. Because the RBA hasn't just been sitting quietly in the background, it's been on a ride. In 2022, the cash rate was at a historic low, 0.1%. Basically nothing. Borrowing money was nearly free. People bought houses, people refinanced, people stretched into mortgages they could just barely afford because the repayments looked manageable. Then the RBA started raising, and raising, and raising. By late 2023, the cash rate hit 4.35%. That's a jump of over 4 percentage points in about 18 months. For someone with a $600,000 variable loan, that translated to roughly $1,500 more per month in repayments. $1,500. That's not a rounding error. That's a second rent. Then, in 2025, something shifted. Inflation started easing. The RBA cut rates 3 times, down to 3.6%. People exhaled. Meet Josh. He's 31, a paramedic in Sydney. Bought an apartment in 2024 on a variable rate. When those 3 cuts landed, his repayments dropped by almost $300 a month. He and his partner went out to dinner to celebrate the 3rd one. Not a fancy dinner, just a pub, but it felt like breathing room. Then February 2026 happened. The RBA hiked. March, another hike. May, another one. 3 increases in 4 months, and every single dollar Josh saved from those cuts. Gone. He's back to exactly where he started. Same rate, same repayments. And now he's sitting there wondering what the hell just happened. That feeling Josh has, that mix of frustration and confusion, is what happens when you experience the RBA without understanding it. And understanding it starts with one concept that sounds boring, but is actually the whole game: the cash rate. Here's what it actually is. Not the textbook version, the real version. Every night, every single business night, Australian banks lend money to each other, not to you, to each other. They do this because at the end of each day, some banks have more deposits than they need, and other banks need a bit extra to cover their obligations. So they lend overnight, just for one night. And the interest rate on those overnight loans between banks? That's the cash rate. That's it. That's the whole thing. The cash rate is the price banks charge each other to borrow money overnight. I'm going to be honest, the first time I read that, it sounded like the most irrelevant piece of information I'd ever encountered. Banks lending to each other overnight? Who cares? But here's why you should care, because that one number, the wholesale price of money, is the foundation that every other interest rate in the country is built on. Your mortgage, your savings account, your car loan, your business line of credit. They're all priced relative to the cash rate. It's the floor of the building. And when the floor moves, everything above it shifts. Now, the RBA doesn't just observe this rate, it sets a target for it. Currently, that target is 4.35%, and the Monetary Policy Board, 9 people, meeting 8 times a year, decides whether that target should stay, go up, or go down. But why? Why would you want to change the price of overnight money between banks? This is where the first piece of the puzzle comes in, the mandate. The Reserve Bank of Australia has a job. It's written into law, and it boils down to 2 things. Keep inflation low and stable. They aim for 2 to 3% per year, and support full employment. That's it. Those are the 2 stars the RBA navigates by. Everything it does is in service of those 2 goals. Now here's the thing. Those 2 goals pull in opposite directions. If you want low unemployment, you want people spending money, businesses hiring, the economy buzzing. But when the economy buzzes too hot, prices start climbing, inflation rises. And if inflation gets out of control, the money in your pocket buys less every month. So the RBA is constantly balancing. Too much heat and prices spiral. Too little and businesses close, people lose jobs. The cash rate is the dial it turns to find that balance. Think of inflation like a slow leak in a tire. Day to day, you don't notice it. Your coffee costs $5.50 instead of $5. Your groceries are a bit more. Petrol creeps up. But 6 months later, you look at your bank balance and realize you're somehow spending more on the same life. That's inflation. And the RBA's job is to find the leak and patch it before you're riding on the rim. Right now, inflation in Australia is sitting around 4.2%. The target is 2 to 3. That's not close, that's a problem. Fuel prices have spiked because of the conflict in the Middle East. Electricity bills have jumped because the government rebates expired. Housing costs keep climbing. The RBA looked at all of that and said, 3 times in a row, we need to slow this down. And the only tool it has, the cash rate. That's wild when you think about it. An entire economy, 26 million people, trillions of dollars of activity, and the lever to steer it is one number. 1. The structure of inflation targeting is, honestly, one of the most elegant ideas in modern economics, and one of the worst explained to the people it affects the most. The RBA publishes its reasoning after every meeting. It's free, it's on the website, and it's surprisingly readable. But almost nobody reads it. So the decision lands as a headline, and the headline lands as a feeling, and the feeling is, they're making my life harder. Stay with me. The next part is where it actually clicks. We know what the cash rate is. We know why the RBA moves it. Now we need to understand how one number becomes your mortgage payment. This is the second piece, the transmission mechanism. And this is where most people's understanding breaks down, because there's a chain involved, not one step, a chain. Step 1. The RBA sets the cash rate target. As of the May meeting, that's 4.35%. That means banks borrowing from each other overnight will pay roughly 4.35%. Step 2. When the cost of overnight money goes up, the cost of all money goes up for banks. Their funding gets more expensive across the board, not just overnight, But term deposits, wholesale funding, bonds, everything shifts upward because the floor just moved. Step 3. Banks pass that cost on. They raise the interest rates on their products, your variable home loan, your credit card, your personal loan. But here's the catch. They don't always pass on the full amount, and they almost never pass it on at the same speed in both directions. When rates go up, your mortgage rate tends to follow within days. When rates go down, banks take their time, sometimes weeks. Sometimes they don't pass the full cut at all. That gap between what the RBA does and what the bank does, that's where the banks live. That's their margin, and it's worth paying attention to. Step 4. Your repayments change. A 25 basis point increase on a $600,000 variable mortgage adds roughly $100 a month. Doesn't sound massive in isolation, but this year alone, 3 hikes have added about $300 a month. Over a year, that's $3,600. That's a holiday. That's a term of school fees. That's real. Step 5. This is the one nobody talks about. You change your behavior. Picture Priya. She's 27, a marketing coordinator in Melbourne. She doesn't have a mortgage. She rents. She heard the RBA raised rates and thought, that doesn't affect me. Then her landlord raised the rent by $40 a week. Because of interest rates, the landlord said. Priya didn't borrow a cent, but the transmission reached her anyway, through her landlord's mortgage. Now picture Tom. He's 44, runs a cafe in Brisbane. Doesn't have a huge mortgage, but his customers do, and when their repayments went up, they stopped buying the second coffee. Some stopped coming altogether. Tom's revenue dropped. The RBA didn't change Tom's interest rate. It changed his customers' spending, and that changed his business. This part still blows my mind. The RBA raises one number. The banks adjust their rates. Borrowers pay more. Borrowers spend less. Businesses feel it. The whole economy slows down. Just a touch. Spending falls. Demand drops. And when demand drops, businesses can't raise prices as easily. Inflation eases. That's the chain. That's the entire transmission mechanism. One number in Martin Place. Millions of changed behaviors. Lower inflation. And here's the reveal. The part that reframes everything. The RBA isn't targeting your mortgage. It never was. It's targeting inflation. And it can't walk into Woolies and tell them to lower the price of milk. It can't call your energy company and demand cheaper bills. It has no power over global oil prices or Middle East conflicts. The only lever it has, the only one, is to make borrowing more expensive so that people spend less, so that demand falls, so that prices stop climbing. Your mortgage going up isn't a side effect of monetary policy. It is monetary policy. It's the mechanism. The RBA needs you, specifically you, to cut back, to cancel the renovation, to skip the holiday, to eat at home instead of going out. Because when enough people do that, the economy cools, and inflation comes down. You're not in the way of the system. You are the system. Your spending decisions, multiplied by millions of Australians making the same calculation, are how monetary policy actually works. That's the reveal. And once you see it, you can't unsee it. I know, I had the same reaction. It feels uncomfortable, but it's also clarifying, because once you understand that your behavior is the mechanism, every RBA decision makes sense. They're not punishing you, they're adjusting you. And they're adjusting you because that's the only tool the law gives them. If your head is spinning right now, you're not alone. Mine did the same thing when I first learned this. So let's clear up the 3 mistakes almost everyone makes. Mistake 1. The RBA sets my mortgage rate. No, the RBA sets the cash rate. Your bank sets your mortgage rate. They're related, but they're not the same thing. And your bank has its own margin, its own funding costs, and its own commercial interests. That's why when the RBA cuts by 25 points, your bank might only pass on 15. The RBA doesn't control that. Mistake 2. Inflation is down, so rates should drop. Not necessarily. The RBA isn't looking at where inflation is right now. It's looking at where inflation is heading. It uses forecasts, models, and data that's sometimes months old by the time it arrives. The RBA is forward-looking. It's steering by where the road goes, not where the car is. Mistake 3. The RBA should just stop raising rates. The RBA has a legal mandate. If inflation is above the 2 to 3% target, and right now it's at 4.2, the board is obligated to act. This isn't Michelle Bullock waking up and choosing violence. This is an institution doing what the law says it must. You can disagree with the framework, but understanding it means understanding that the decision isn't personal. There's a whole rabbit hole about quantitative easing, the yield curve, and the RBA's balance sheet that I'm not dragging you into today. That deserves its own video. What I've given you here is the engine. The rest is the dashboard. Now, what do you actually do with this? Every situation is different. What you've just learned is the framework, not the answer for your specific circumstances. But here's what knowing this unlocks. On rate decision day, and the next one is the 16th of June, go to RBA Govern AU, read the statement. It's short. It's in plain English. And now you'll understand what it means. You'll see whether they're worried about inflation, employment, or both. And you'll know why the rate moved or didn't. If you're on a variable rate, check whether your bank passed on the full change. If they only passed on part of a cut, you're leaving money on the table. Call them, or compare rates. The average variable rate right now is around 6.84%, but competitive lenders are offering under 6%. The difference on a $600,000 loan is thousands of dollars a year. If you want to go deeper into personal finance in Australia, the Barefoot Investor is a solid starting point. It's Australian-specific, no nonsense, and covers the basics without talking down to you. And the RBA's own website publishes meeting minutes, speeches, and explainers that are genuinely worth reading. So, let's land this. 3 things to take away. 1. The cash rate is the price banks charge each other to borrow overnight. It's the wholesale price of money. Every interest rate in the country is built on top of it. 2. The RBA moves the cash rate to control inflation. Its target is 2 to 3%. When inflation runs too high, it raises the rate. When it runs too low, it cuts. That's the mandate, written in law. 3. Your mortgage going up isn't a side effect. It's the mechanism. The RBA needs you to spend less so that demand falls, so that prices stop climbing. You're not collateral damage. You're the policy. Here's how I'd reframe the whole thing. The RBA is the one institution in Australia that can slow down or speed up the entire economy. And it does it by changing one number that changes your number, that changes your behavior, that changes everyone's behavior. That's not a flaw. It's the design. And now you understand it. Most Australians will live their whole lives reacting to RBA decisions without ever understanding why they happen. Panicking on rate day, celebrating on cut day, never seeing the chain. If you're now the person in your family who can explain this, the next rate day won't feel like a punch in the gut. It'll feel like a weather forecast, something you can read, prepare for, and talk about without panic. And if this video plants that in even one person who was about to panic sell or panic lock without understanding why, that's the whole point. Remember Josh? The paramedic in Sydney who watched his savings from 3 rate cuts evaporate in 4 months? He didn't do anything wrong. The system did exactly what it was designed to do. The difference now is that you understand the design. This is general education, not personal financial advice. If you need advice tailored to your situation, speak to a licensed financial advisor.